All right, let's tackle one of the biggest, oldest debates in the investing world. What's the smarter move? Should you consistently invest your money every single month, no matter what? Or should you hoard a big pile of cash and wait for the perfect moment to buy when the market tanks? It's really a classic showdown: discipline versus perfect timing.
But before we get into the nitty-gritty, let's start with a little thought experiment. Just imagine for a second that you had a financial superpower. I mean, you could know with absolute 100% certainty the exact bottom of every single market crash. You literally could not get it wrong.
So picture this investor. They can basically see the future. They know the precise moment to dump all their cash into the market to get the absolute lowest price possible. You'd think an investor with that kind of perfect vision would end up light years ahead of everybody else, right? Well, stick around because the real answer might actually blow your mind.
Okay, so let's really dive into this. Welcome to everything you need to know about finance. Now, to figure out if our superpowered investor actually wins, we've got to put their strategy head-to-head with its complete opposite. And just a quick heads up as we get into the numbers, this is just a deep dive on the topic, not financial advice. Oh, and hey, if you find this kind of stuff interesting, do us a favor and hit that like and subscribe button. It really helps us make more. All right, it's time to meet our contenders. In one corner, we have the market timing superhero, and in the other, we have the steady, disciplined, consistent investor. These are two totally different ways of thinking about how to build wealth.
So first up, we have the buy the dip strategy, or BTD for short. This is our superhero's game plan. The idea is super appealing, right? You just save up your cash, wait patiently for the market to freak out and crash, and then bam! You throw all your money in at the absolute bottom. The goal is simple: buy your favorite investments at a massive discount.
And in the other corner, you've got dollar cost averaging, or DCA, and this could not be more different. With this strategy, you just invest a fixed amount of money, let's say $100, every single month, just like clockwork. You don't care if the market is soaring to new highs or if it's in a total freefall. You just keep buying. It's automatic, it's disciplined, and it takes all the emotion and guesswork right out of the equation.
And when you put them side by side, you can really see how different they are. Buying the dip demands perfect timing and it's super high risk, but it dangles that carrot of huge returns. Psychologically, it's a nail biter. Dollar cost averaging, on the other hand, needs zero timing, it's way lower risk, and it's all about getting steady, predictable growth. It's just a much calmer, more disciplined path.
So you've got the high-stakes gambler with a crystal ball versus the slow and steady tortoise. It kind of feels like we all know who should win this race. But, the data? It tells a completely different story.
So let's cut to the chase. After, say, 40 years of investing, who actually has more money in the bank? The person who could perfectly time every single market crash, or the person who just automatically invested a little bit every single month without even thinking about it?
The result is, honestly, it's stunning. Studies that looked at decades of real market data found that a simple, boring dollar-cost averaging strategy actually beats a perfect buy-the-dip strategy more than 70% of the time. Just let that sink in for a second. Even with a literal superpower to predict the future, you'd still lose to a simple automated plan most of the time. How is that possible?
I know, it feels totally backwards. It just doesn't make intuitive sense. So the real question is, why? How on earth can a dumb automated strategy consistently beat a genius one? Well, the answer is hidden in a few really powerful and often overlooked truths about how the market actually works. It really boils down to three big things. First, those massive, life-changing market crashes, they're actually pretty rare. Second, all that time the buy-the-dip investor is waiting for that crash, their cash is just sitting on the sidelines doing absolutely nothing. And third, it's the perfect proof of that old saying you've probably heard: time in the market is so much more important than timing the market.
And that right there is the secret weapon of dollar cost averaging. Every single dollar that the DCA investor puts in gets to work immediately, earning returns, which then start earning returns on themselves. That is the magic of compounding. The buy-the-dip investor misses out on years of that growth while their cash pile is just sitting there getting slowly eaten away by inflation, all while waiting for a super rare event.
And you can see exactly how this plays out over time. In year one, the DCA investor starts putting money to work, while the BTD investor is just holding cash, waiting. By year three, our DCA investor is already seeing their money compound and grow, while the BTD investor is, you guessed it, still waiting. And even when a big crash finally happens, say in year 8,
and our superhero investor makes their perfect move, it's often not even enough to catch up to all the wealth the DCA investor has already built up over all those years of consistent, steady growth. Okay, so what in the world does this all mean for you as an investor, right here, right now? This isn't just some dusty old historical analysis. It's a really powerful lesson in how real wealth is actually built for the long haul.
You know, this quote really sums it all up perfectly. Forget trying to time the bottom. Nobody knows when that hits, not even the so-called experts. I mean, think about it. If a hypothetical, all-knowing investor with superpowers can't even reliably beat DCA, what chance does a regular person like you or me really have? For most of us, trying to time the market is just a fool's errand that ends up costing us a ton in missed gains.
So really, the key is to completely flip your mindset. When the market starts to drop, a disciplined DCA investor doesn't see a threat. They see an opportunity. They know their regular, automatic investment is now buying them more shares, more units of their favorite investments, because everything is on sale. That simple psychological trick turns fear into a massive strategic advantage.
At the end of the day, when it comes to those huge, long-term goals like retirement, the data couldn't be clearer. A disciplined, consistent habit of investing is a much more reliable and surprisingly often more profitable path to wealth than trying to be a market timing genius. It takes the emotion out, it puts compounding on your side, and makes sure you're always participating in the market's general upward climb over time. So, as we wrap this up, it really leaves us with a pretty important question to think about for the future of your own investments. After seeing all this, are you building your financial future on a solid foundation of discipline, or are you just hoping to get lucky with a roll of the dice? The choice, of course, is all yours.